Have you heard of the concept of becoming your own banker or being your own banker, but you're a little bit confused about how to put this into action in your life? If you are, go ahead and put yes in the comments below. I would love to hear what your thoughts are on being your own banker as you're coming into this conversation. Now, becoming your own banker was popularized by Nelson Nash. Now, he was the father of infinite banking, or IBC, the infinite banking concept. And he really found this way to utilize a whole life insurance policy by borrowing against the cash value to get him out of a really bad financial situation. And from that, he realized that if we could design whole life insurance policies in a way to maximize the early cash value, then people could have access to more capital, essentially using whole life insurance to do a whole lot more than just insurance throughout the course of your whole life. Now, I want to walk you simply through the 3 steps that you need to implement being your own banker. The first is to keep cash reserves. Now, what do I mean by that? Well, the bank, if you think about what the bank does, we put our money into the bank in savings accounts or checking accounts or CDs. And the reason for that is that we're looking for safe money. We're wanting it to not drop in value, but we are expecting that it's going to be there for us. Now, being able to use that cash is important, but the most important thing about the bank is that it is a store of capital. Now, we can keep our cash in the bank and we know that it's going to be there. It's like a warehouse or a safeguard, a safe place to store your cash. Now, what I'd like to do is challenge you to think about that same cash in the bank's reserves from the other lens or the other perspective in the equation. You as the customer of the bank is putting your cash in the bank for safekeeping. However, the bank on the other side is receiving those cash reserves. They're going to pay you for the use of that capital. And why do they do that? They're very interested in being able to have those cash reserves because what does that allow them to do? They can then make loans to other people and they can put that cash to work. Now that cash reserves that's in the bank, they don't have to keep a 1-to-1 reserve ratio. So because of fractional reserve banking, they're actually able to leverage that even more than you or I could, but they're able to make loans that will be repaid at interest, and they're able to charge more interest on those loans that they make out to people who they expect to be repaid from. This is why banking is the most profitable business model in the world. If we look at being a customer of the bank, we earn a return or interest by keeping our money in the bank. However, on the bank side, they pay interest for the use of that cash because it's so valuable to them. It allows them to make loans that earn them cash flow, that put them in a position of control, and it's all because they hold reserves. So if we're going to be in a position of being the banker in our own life, you need to start by keeping cash reserves. And what do I mean by that? Well, if you have money coming into your personal economy or your reservoir, your tank, if you will, this is all the money that you make through your investments, through your income, through your jobs, or your businesses. And when that money comes into your house, if you will, most of that ends up flowing out. Whether this is through some sort of transaction, you're paying for the mortgage, you're paying for groceries, you're paying for gas, you're taking your capital and you're putting it in the control of someone else outside of your own personal economy. Now, this also happens when money flows out of our reservoir or out of our hands when we pay taxes. That money transfers into the IRS's hands, or when we pay interest and principal on any loan. This could be a credit card or a mortgage or a car loan. When we pay that, that money then goes into the hands of the banker, if you will, the mortgage company or the financial institution. Even when we make investments, usually that money is then in the control of another financial institution. So when we think about the flow of our money, what we want to do is make sure that we keep some of our own cash in reserves. And the way we do this is by paying yourself first. This is true savings. And it's not the savings where you're just saving money up for a future purchase. That's just delayed spending. What instead we want to do is save up by keeping a portion of all that we earn. If you take this concept all the way back to The Richest Man in Babylon by George S. Clayson, he says, put your purse to fattening. Meaning, if you make $10, keep 1, only spend 9. You make another 10, keep 1, only spend 9. You can increase this concept and even say your goal should be to save and keep in your own reserves 30% of everything that you make. Now on to step 2. This is own the reservoir. When you think of who is holding and controlling capital, this can be often misleading because we think, well, if the money is in savings, it's in the bank, then I control that capital. actually the bank is controlling the capital in that case. The reason is that they have access to be able to put that money to work and use it. Now, sure, you can access it. It's not going to drop in value. But when you really are looking at a position of control, you want to own that reservoir. Now, sure, you could say, well, let's just put the money under the mattress or in a coffee can in the backyard. That I own. And yes, you do, but you can't put your money to work if you're hiding it. So what we want to do is figure out how can we have a reservoir where we keep our money, where we're saving, and we're putting that money in our own control. Now, when we think about control, you want to think about, first of all, can I make sure it doesn't drop in value? Can I make sure that I can access and use this money? Is it going to earn uninterrupted compound interest for me? The key here with control is, can I earn interest? Can I access this capital and will it not drop in value? I want as much safety, as much liquidity, and as much growth on this cash as possible. So where's the ideal tool or vehicle to keep my own cash in a reservoir that I control? This is where the concept of infinite banking really comes into play. The ideal tool to use is a specially designed whole life insurance contract. And why would I say insurance? Because you would think that if I'm putting my money into an insurance policy, the insurance company is controlling that capital. However, the reason that you are controlling capital when you put it into a privatized banking policy or a specially designed life insurance contract is that you want to utilize a mutual company. Now, this company is owned by the policy owners, meaning you own the company. You receive a return of the revenue through dividend payments. So when the company is profitable, you receive that gain in your policy in the form of a dividend. This cash is also accessible to you because you can access it through a guaranteed loan option, meaning that when you have cash value and reserves, you can access up to that amount of capital on a no questions asked basis. Now, in terms of earning, you have the ability then to earn interest because when you have your money compounding and growing inside of a life insurance policy, you never interrupt the compounding of that capital as long as you have the policy in force, even when you borrow against it. So you're getting safety, liquidity, and growth. Now, this owning the reservoir puts you in the position of control because you're able to do what the bank does. You're able to earn interest. You are able to have that capital in your control. And because you have that capital in your control, it leads us into step number 3 of becoming your own banker. And that is to master the art of arbitrage. Now, here's what the bank does. They pay for the cost of capital just the same way that you and I do. That's why they pay interest to a depositor. That's the cost of capital for them. So let's just say 1% on a dollar. That would be a penny. That's their cost for the use of that dollar. Now, if they're able to turn that dollar into a loan, and we're not even using the fractional reserve system at this time and making that into $9 of loans and keeping one in reserves, let's just talk about loaning out that $1 at a 5% interest rate. They're going to have then 5 cents come back into their hands as a result of controlling that $1. So their cost of capital is 1%. Their earnings on that $1 is 5%. Now, if we look at the gains, their payment of 1 cent earned them 5 cents. So because they controlled the dollar, they actually had access to 400% return on their money. Now, you can do the same thing because you have cash in your life insurance policy. You can borrow against it, and say you're paying a 5% interest rate for the use of that capital, you can then put it to work in another maybe business or real estate venture, and you can earn whatever return you can make in that outside endeavor. Now, what this does is it allows you to use the same banking principle of arbitrage. You're still paying for the cost of capital, but you're putting it to work in a higher return environment and maximizing your returns. So say you're able to take a policy loan at 5% and put that to work in a rental property, earning 20% cash on cash returns. That would be a wonderful position of arbitrage. You're using leverage to create velocity of money and have your money do so much more for you. Now, here's the key as well. The bank doesn't just pay interest for the use of capital. They're also earning interest. And you're able to do the same thing, not only with arbitrage, but your money continues earning that uninterrupted compound interest. And so you're making a return. You're earning interest on that capital as you store it inside the life insurance policy. So in closing, these are the 3 steps that you need to master to become your own bank and be your own banker. That is, first, to keep cash reserves. Second, to own the reservoir. And third, to master the art of arbitrage. That's investing in what you know and control so that you can have the maximum returns but still stay in control. And by the way, if you want to go ahead and supercharge this concept of being your own banker, I encourage you to get our Investor's Quick and Easy Guide to Privatized Banking that shows you how to earn a return on the same money in two places at the same time, so you can keep your money at your disposal and earn maximum returns at the same time without increasing your risk. Hey, I hope you liked this video. If you did, click the link in the description box below for more information. And don't forget to like this video. Share your comments, questions, and feedback in the comments section below, and don't forget to hit subscribe to our YouTube channel.